Down in the stream. Let's just get a quick audio check and then we'll get into it. Okay, we're good. Seems like we're good. Okay, I think we are good. Okay, we're going to start with bias, then CPI, then economic calendar events, and then by the time I'm done with that, CPI should have come out. Then we'll talk a bit about the London silver bullet and the New York PM silver bullet, and then we'll go into trade management and holding your winners for even longer. CPI is tomorrow. It's Wednesday. PPI. Oh my god, I'm so stupid. Oh well. I'm so stupid. Okay, whatever. PPI. Let me change the title then. Oh, I messed it up. I was meant to do the CPI stream tomorrow. Yeah, fuck. Oh well. Yeah, early stream today. This is what happens when you don't know what day it is. It's fine. I'll freestyle. That's so annoying. Now I have to, okay, forget CPI. We'll talk about that tomorrow. No, it's so stupid. Okay, I still have a bunch of talking points that we can do, so it's fine. I don't know why I thought it was today. That's weird. Anyway, my bias today, I'm bullish, and I was holding a sell trade, but I am bullish. I did say in daily analysis today. I had a good trade this morning. I'll go through that trade in a bit. I want us to reach in further into these buy side pools because this is low resistance liquidity. If we're looking at this through the 4-hour chart, we've got a high. We put that high in, we break down, spool all the way down here, and then we make a quick shot back up, but it's a failure swing. So on the 13th of August, we put in that high. The 14th of August, we put in another high, but it's a lower high. So that failure swing. Then on the 15th of August, we did the same thing again. And then again, and now we're trading up into that range. We have taken out this high. That's why I'm looking at this August, the 14th high. That one. And then the August, the 13th high. My draw on liquidity yesterday was reached just after stream ended. It was previous week high, 23,902. That was traded into PM last night, and I'll go through that trade that I took based on that today. Can you please confirm on the 1 hour, is it a change of state of delivery? Okay, fine. Yeah, change of state of delivery. So because you closed above the 3 a.m. and 4 a.m. hourly candle, that's a change of state of delivery, which validates this as an order block. And the fact that you left a fair value gap there's even better. Okay. I'll go through a couple of trades. Actually, wait. before I do that, I was going to make mention of the new week opening gap. That's not even the right one. This one. But that's because we had CPI, but we don't actually have CPI. I'm just stupid, so I'll leave that for tomorrow. Going into this. Okay, yeah, we're going to go through London Silver Bullet. So you were asking, not all of you, some of you were asking how I took that trade in the morning, where we top ticked London. I didn't intend for this to be a top tick. I was looking at a sell day, and then I realized I was offside later on. I took my partial, and then I just let it run anyways, because why not? And then, because I could kind of see it going both ways. The reason I sold up there is because we were past midnight opening price. This is the classic buy or sell day profile, where you want to see a Judah swing above midnight open. You sell at that Judah swing, you put a 50-point stop loss on, and then you hold that going into the 9 to 10 a.m. hour. Obviously, I realized I was wrong, so I took that partial and I put it at break even. Is it your audio that's soft, or is it a me problem? I can turn it up if you want. His mic is cold, yeah. I turned it up, is that better? Do you sell when your bias is bullish? Sometimes I'll counter trend trade, and I wouldn't recommend it. There's really no advantage to it. You'd rather just go with your bias. But if I have a bullish bias, but I know that London's going to reverse off a key level, then I'll take that trade anyways. Because I can do that, I'm experienced. But I don't recommend it. So I took that partial and got break even. This is a London reversal, so even though I took it with the intent of getting a classic sell day, obviously that was wrong. And that would be classed as a London reversal trade. Take these off now. But let's look at this through the lens of a silver bullet. Okay, this blue hue box is a silver bullet. We don't need anything past there. So in the silver bullet for London session, what opening price are you going to use? You're going to use the midnight opening price, and you're going to use the new day opening gap. Let's mark the new day opening gap out. I don't have it on this layer, I use it on my other one. So that's the closing price at 4:59 and the opening price at 6 o'clock. See that? That's perfection. Anyway, we trade above midnight open, above this initial buy side that was formed after Asia, and then now we're in a premium, right? Because we're above midnight open. So relative to the daily range, if you have an underlying bearish bias and you trade above midnight opening price and you're looking at a silver bullet trade, being above the midnight open during the London session in between 2 and 4 a.m. is a very deep premium, and you can utilize that to look for sells. We're not going to cover the midnight opening range. We're just going to look at this through the lens of a London trade. So internal, it's not external range liquidity was taken. That's all you need for manipulation. You don't need previous sessions or previous days. It can be as simple as a high like that. So a lot of people have this misconception that you need to look for a daily high or a daily low or a weekly high or a weekly low. It can literally be something as small as that. When you're looking at short-term manipulation, for a silver bullet, a high like this sells perfectly fine. And this is actually a fulcrum as well. We'll look into that a bit later. So when that happens, what you're looking for now? Liquidity sweep. What's next? Market structure shift or change in state of delivery. That's aligned with your underlying bias and narrative. So if your underlying direction is to trade back into the new day opening gap, into this inefficiency inside of Asia, or into these relatively equal lows, either of those are fine. You can target these relatively equal lows. And you're bearish, then the second you get a bearish market structure shift, you can start looking for entries if it's a high probability bearish market structure shift. So that's a high probability one. Why this one? A lot of people would use that one. You can use that one, it's fine, but this is the low of the fulcrum, and to me, because I'm pretty good with fulcrums, I would use that. But if you're not very familiar with fulcrums, you can use this one, it's fine. And if you followed this pattern-wise, it would have been like that. You would have sold on this, and you would have captured that entire move. Realistically, am I selling in there? No. If I was taking the silver bullet, for me personally, I would use this as my market structure shift. I would use this as my volume bounce entry, the value gap entry. Because this is a doji candle, you ignore the wicks, so you can go through that. This is mentioned by ICT in 2025. When you get a candle like this, where the body is that arrow, so the open and the closing price are the exact same, or negligible in difference, then you ignore that wick and you can go into the one previous to it. So you could have entered on that gap, you could have entered on this bearish order block, you could have entered on these gaps, you could have entered on that gap, and then trade management wise, say you're in on that fair value gap, and that's a generously late entry. Your stop loss goes at that high. Where's your full take profit going? You can target these relatively equal lows. I would have targeted the new day opening gap. And this is the reason I taught new day opening gaps, because although I say you can use them as support and resistance, you can also use them as a draw. And during the London session, during the Asian session, during the pre-market hours, it's going to typically, during at least one of those, refer back into the new day opening gap. So if it doesn't in the Asian session, it did, but if it didn't, you would look at it again in London. If it didn't happen in London, you would look at it again in the pre-market hours, etc. So trade management. Say it displaces lower after you enter. You're probably excited by that point. You're thinking, oh, it's going to go in my direction, blah, blah, blah. It retraces against you. That thing's very annoying. And it retraces against you. If you had your stop loss at break even already, how frightened would you be that it's going to stop you out at that point of the trade? I would be pretty frightened, because I wouldn't want to be having a trade that went really well initially. It looked like it was about to be a winning trade, a really one-sided trade, and then it comes all the way back up there, very close to my drawn liquidity, or my stop loss. So this is what I mean with trailing your stop. If you're not yet, you don't have to be an advanced trader, but you have to have a level of experience where you know at what time you're able to start trailing that stop loss. Just because price traded down there, you shouldn't put it to break even. You can trail it that much, and you can trail it to the top of the fair value gap, but trailing it all the way down to break even, very, very dangerous in my opinion. I don't recommend it, and initially, I think it's stronger and better if, or not stronger and better, but oops, I plugged in the microphone again. What was I saying? Stop placement. News. Damn. Nice. That's why you don't trade news, ladies and gentlemen. Imagine if I was holding that trade without having it at break even. That slippage would have killed me. It still hasn't tagged out that major buy side, but I like that I left this low here. Anyway, back to the stop placement explanation. You really shouldn't be trailing your stop loss at this level in your development. I know most of you are not like brand new to trading, but generally I would recommend that during your back testing, during your forward testing, during your tape reading, when you're mentally entering positions or physically entering positions, you're not looking to trail this so tightly, and you're not looking to set it to break even until you're at least past equilibrium. So where's equilibrium here? It's there, but even then it's kind of dangerous. I wouldn't recommend it. There, if you're using that, and then if you're using the new day opening gap, it's there. So bottom line, don't trail your stop loss too early until you're already at, close proximity to your take profit like that. Yeah. Regarding the new day opening gap and order flow, London was really clean today. After that market structure shift, if you entered, you're looking for every up close candle to provide resistance to bearish price delivery. So this up close candle, when we trade back into it, it's provided resistance for this candle or for this price run, like that. Up close candles provide resistance, and then we reach our drawn liquidity. So that ties back into order flow. When you're looking for one-sided price delivery, and in a silver bullet you want to see this. And if you're not seeing that, it takes away confidence for me in the trade. But then this is also why it's important to be referring constantly to the 5 and 15-minute chart. On the 15-minute chart, you have something like that. That to me puts a lot more confidence in my position, because I'm looking at multiple time frames and gathering points of reference for each one. And if we're reacting to a fair value gap or a SIBI on the 5-minute, and then on the 1-minute we're reacting to that bearish order block, we've got a bearish market structure shift, we've got these relatively equal lows, we've got the new day opening gap, we've got the fact that we priced above midnight opening price. All of that is enough of a narrative and bias and a setup to take a silver bullet sell trade. That's what all of your trades should look like. Generally, you want to see across your data collection that all your trades look similar. They don't need to be exactly the same. The candles aren't going to ever print out the exact same. But, you want to always see liquidity sweep, market structure shift, fair value gap, entry, bearish order flow. Bearish order flow again being up close candles providing resistance to down close candles. Yeah. Okay, this is our data high. So this is our data low. Where is it? It's this one, isn't it? Are you looking to trade right now? Nope. You want to see at least one side of these run, and you want to let more information start printing out on your charts, because this manipulated this sell side. It didn't take all of it out, admittedly, but then it also manipulated that high. So you want to sit on your hands and wait. Don't try and force anything, don't try and rush. Just chill. Can your entry be outside of the 3 to 4 kill zone if the setup itself formed inside? Yeah, that's a good question. You're not looking for every single part of the model to form in that 1 hour window. As long as something, aka the liquidity sweep, the market structure shift, the bearish displacement, one signature of that model, this model, the silver bullet model, happened in your given time window. For us, it's 250. 250 until 410. That's our time window. So you can enter outside of that, absolutely. You can enter there if you have to. Okay, on high impact news days, you always want to have the 8:30 opening price marked out. So 8:30 open. And then being above 8:30 open and midnight open, that's an overbought condition, where if you're bearish, this is deep premium now. And you'll notice every time I'm saying discount premium, I'm referring to bias and narrative. You're not in a discount, you're not in a premium if you're going to keep trading higher into, other buy-side liquidity pools. What if we trade all the way up into this level here? Would this still be a premium? Nope. So you have to take into consideration those biases, the narrative, where price is likely to go, all that stuff. I'm not going to sit here and just look at these news candles. I have a couple other topics to go through. Okay, regarding the economic calendar, the reason I didn't do a weekly outlook this week, A, I was busy, 2, I recorded it twice and messed it up because my microphone was muted, and 3, I didn't like that Monday and Tuesday would be very unpredictable for me. Why would they be unpredictable? Well, there's no news. I don't know specifically when manipulation is going to occur on these 2 days. So Monday and Tuesday could consolidate both lower, and it would be completely irrelevant to the rest of the week. So rather than doing a weekly outlook on Sunday and kind of guessing at where Monday and Tuesday would form, I held off on finishing that off and waiting for the news events in the later half of the week. We've gotten through Monday and Tuesday. Those were going to be, the worst portion of the week. Now I've got, news is finished now, but we've got CPI tomorrow, and then we've also got a high impact consumer sentiment on 10 a.m. tomorrow, Friday. So how do you use this to frame trades? With a silver bullet, you're looking for low resistance conditions. I said that in lecture 4, intervals of engagement. When are the low resistance conditions going to form? They're going to form on these high impact news days. Even ahead of news, if you're looking at the London session, that is a lower resistance condition than Monday this week was, or Tuesday this week was, because we had just finished Friday, which was a large range day. Monday had no news, so Monday was going to be like the worst day of the month, really. And then, to top it off, it's a Monday. They're never really going to be amazing. And then Tuesday's the day following that, prior to PPI. For some reason in my head, my dyslexic mind thought this was CPI and this was PPI. Stupid. But it doesn't really matter. Yesterday's PM session. Okay. Can your I read that one. Breakaway is still bullish. Only one buy side liquidity left. I wonder if current weekly profile could be midweek reversal. Potentially, yeah, potentially. But with all time conditions, you really don't want to be predicting a reversal. You just letting it continue higher, and then any sell side manipulation you get, you want to just see if price is going to react in a bullish way where you can trade it back into all-time highs. Because if we do take out our next pool of buy side, major buy side liquidity from 24,068, that's also our all-time high, and you don't really want to be shorting all-time highs. So okay, PM session, it trades into this bullish order block from the lunch hour. Then what are you using for your opening range in the PM session? You're using 1:30 until 2 o'clock. Those 30 minutes are going to usually set the foundation for the rest of the session. Now, in this case, it was just consolidation. What do we know about consolidations? Well, this is held in a tight range. Out of a smaller range, you're going to get a larger range. And out of a larger range, you're going to get a smaller range. And out of a smaller range, you're going to get a larger range. You know, that little entry pattern, not the entry pattern, but the idea that small range, large range, small range, large range. You have to have that in your mind when you're using the silver bullet. Why? This is your indication that, or indicator, that price is going to want to expand. So when we have this time distortion in the opening range going into the 2 o'clock hour, and then in 2 o'clock we start spooling, take out these two highs, that high, and that high, those relatively equal highs from the consolidation in the opening range, and we spool again, take out the opposite side. This is like, think of it as a mini seek and destroy profile. Up, down, up, down, up, down, up, down. It's consolidating, it's whiplashing back and forth. You don't want to be in that. But you can use it to frame the idea that we're in the silver bullet time window between 2 and 3. Where's the setup going to form? Between this hour. So the fact that we've consolidated in this hour, rather than thinking that's a bad thing, it's the opposite. It's a good thing, because now you know small range, large range, small range, large range, small range, large range, small range, large range, etc. So we take out the low. What does that mean? Does that mean I'm going to buy the first change of state of delivery in fair value gap? No. It means I'm going to let my narrative set in, and I'm going to frame it in a way where I can see it going higher into a bullish draw. Is there a market structure shift there? No. The nearest market structure shift is that. Have we displaced above a SIBI? No. That didn't get inverted. It closed at the high. What do I teach? When it closes at the high, what's it going to do? The next candle is likely to be the opposite. It was. So we don't get any form of change in state of delivery. Some people would say this is a change in state of delivery. And although technically it is, you're not using that. We're taking it to the next level, and we're looking at the broader picture. Where's the narrative? Why is price going to actually use it as a change state of delivery to go higher? Is it? No. It hasn't given us the market structure shift. It hasn't given us the signs that it wants to go higher. So that doesn't occur until there, and that doesn't occur until there. But we don't need that fair value gap. It rallies lower. Oh, sorry, it drops lower, and then it rallies higher. Does it need to take out this low? No. Why? It already took out the low. It's taken out sell side. What's that? Well, you can see it as a bullish order block or rejection block, whatever you want to see it as. Failure swing. So it leaves these relatively equal lows there. Doesn't really matter. We've already taken out sell side. This is a protected low. We don't want to see that taken again if we're bullish, because we have an intermediate term low, a long term low, intermediate term low. If we're bullish, we don't want to see this taken out. So it misses that low. First indication that you're bullish. Up, down, change state of delivery. When we trade above that, it uses this order block. But am I looking at this to trade yet? No. Technically, that's a market structure shift. Technically, that's an order block entry. Realistically, am I going to enter here? Is that enough confirmation for me? Of course not. What I've been teaching in the last however many lectures we've done, 11 lectures, that's not enough of an indication, or that's not enough of the market telling me what it's going to do. Because it could have taken out this high, used this bearish order block as a turtle soup to go lower, and it would be my fault if I entered there and did it wrong. But then it leaves that area with the breakaway gap. So that's a breakaway gap. Doesn't return into that. What does that mean? What did I recently teach? Breakaway gap, when you trade through a market structure shift and displace through it, is an extremely powerful sign that you're bullish and you're going to start hunting higher time frame liquidity pools. It does work this high, and I didn't like the reaction to that high. I thought, okay, maybe this is just a lower time frame market maker model. What if it just rejects this high? I'm not going to enter yet. But then when it reacted to this, well, it's a bounce price range, but I don't really want to teach bounce price ranges yet. But it was a bounce price range. It reacted to that. I bought there, and then I sat through. It traded up again. Did that dissuade me from looking at another trade, or from being shaken out of my position when it traded back a little there? Nope. Because in my head, I knew that this breakaway gap is protected. If we're bullish, it shouldn't drop down below that breakaway gap. Should it? No, of course not. My target was based on something else that I'm not sharing yet. So stop placement, you don't trail it just because it displaces in your favor, because so many times it's going to come down and take out whatever consolidation you had. And I explained this in my implied dealing range, or in my grading implied ranges lecture, where it'll come down back into the 0.5, take out the equilibrium's consolidation level, and then rally higher again. But my indication to not trail my stop was that we had the breakaway gap there, and it's still valid to trade back below this relatively equal lows, or consolidation lows, whatever you want to call them. Leave the breakaway gap and trade higher. So had I trailed it into break even, I would have got cooked. And then in London, if I had done that as well, I also would have lost. And I don't want to lose. So you have to learn to assume that level of risk, where I understand it's scary to have that money on the line, but you know, that's what you have to do as a trader. You have to assume risk. And then it rallies higher. My profit got taken there. This was the daily high that I mentioned yesterday as the drawn liquidity for the day, and it didn't get reached in the AM session. That's why I was confident in it getting reached in the PM session once we had the breakaway gap and the reluctance to leave it. But you see how easy that is. Have a bias, have a narrative, and you'll win most of the time. Doesn't the body have to close above the wick for it to be a market structure shift? No, it doesn't. It can wick through and it's fine, but ideally the body closes above. If you're still struggling with that though, you can look at the lecture from I think 2 days ago. It's titled Market Structure Shift, so we explain it properly there. What's the difference between a breakaway gap and a fair value gap? That's also explained in the Market Structure Shift video, but I'll go through it in a second. Yeah, all-time high conditions, very annoying, but it is what it is. Okay, a breakaway gap is where you break away from the range without trading back into the fair value gap. So it's really simple. This is a sign of incoming speed and the idea that you're hunting a higher time frame liquidity pool. So where I had that daily high yesterday, daily chart. I'll make it a big orange. Okay, remember yesterday in stream where I said we're looking at this, and then in the daily analysis I said that on Discord as well, and then in the YouTube post I said it. We were looking for this daily high to get reached. We're in a small range. We break away with this breakaway gap. This doesn't get traded back into. The best breakaway gaps are not going to have any price action in it. It's just inefficient delivery one way. So we trade up and we leave it so there's nothing coming back inside of that. That's what a breakaway gap is. And ideally you want that to be towards the 20 to 30% of your unrealized range, which it is. And it leaves it again. It leaves it again. That's a sign that you're hunting higher time frame liquidity pools. So 15-minute liquidity pools, 15-minute relatively equal highs, new week opening gaps, daily highs and lows. How else would I have been more confident that it's going to reach the daily high? Because it failed to do it in the New York AM session. But then we rallied up, traded above this high, showed a signature that we're going to keep going higher by avoiding the breakaway gap again. We just missed it. That's the algorithm telling you daily high. Very easy, very simple. So you're looking for breakaway gaps from bottoming and topping structures. It's a bigger, strong candle that shifts around the midpoint of the range. I don't know what you mean. Can you rephrase that, Michael? Nikhil? Yeah, textbook breakaway gap. Okay, I'm going to have some water and then we'll go to the next part. I want to talk a little bit more about market structure shifts. And first we'll look at our London setup. How do you know which market structure shifts are going to perform and which are going to leave you in the dust? Well, first, you want to know that every single reversal is going to have a mitigation block or a breaker block. That's very important. Which market structure shifts are going to perform the best? The ones that are a breaker block. You need to make note of that because that's a very important thing to know. This is a breaker block, and it's also a market structure shift.